From YOLO to struggle is real. From binging on every show on Doordarshan to sharing every other OTT subscription.
From saving every rupee gotten as gift religiously in a piggy bank to digital money, us millennials have come a long way.
Well, welcome everyone to the evening where we discuss all things fintech. I'm your host, Anagha Sridhar.
And I'm your other host, Vaishnavi. Before we jump in, we would like to introduce Tether. Who are we?
In a nutshell, we are fintech enthusiasts, but there's more. Tether was conceived by like-minded individuals with backgrounds in financial services ecosystem. In addition to being a converging point for all things fintech, Tether is a space to learn and grow. The community also functions as an open forum where participants can reach out to industry experts, making the whole community bigger.
Join the community right now. Whether you are a fintech startup looking for investors or a fintech enthusiast wanting to stay updated with the latest in the fintech world, Tether is the place to be. Presenting to all of you a small glimpse of Tether through a video.
The strength of the wolf is the strength of the pack. The strength of the pack is the strength of the wolf. Since our founding, M2P has wanted to give back to the community we grew from, which led to the birth of Tether. Tether is a community for like-minded people from across the globe. This includes startup founders, fintech professionals, students, and enthusiasts. Tether, with thousands of members like you, will act as a catalyst in the growth of the fintech industry. Tether also acts as an open forum where participants can reach out to industry experts, learn and grow. You can achieve mentorship from industry leaders, mentorship for funding, an opportunity to network with peers, and access to a world of events apart from a host of services. Join your peers today. Grow together, tether together.
Right. So log on to tether.community to become a member today. The link is now available on the chat section of the screen.
Now to jump into what we have as agenda for today, digitalization is fast changing the world around us and also changing the prominent faces. More specifically, the millennial generation is coming to its own all around the world, and online trading is just one of the sectors that is transforming to cater to these young investors. Stock trading was often one of the most popular options for beginners trading.
However, Anagha, today with the enormous diversity in choices available, mobile trading is changing the face of online trading. Through this kind of trading, users purchase the option to purchase a certain amount of stock of at a predetermined date in the future.
There seems to be a lot to discuss here, and to throw some light on the millennial way of trading and investment, we have Mr. Shiv Sharma here along with us.
Mr. Sharma is the VP of International and India Head of Stocktwits, one of the world's largest social communities of investors and traders. Prior to joining this organization, Shiv worked at Amazon Web Services and has nearly 10 years of tech investing experience in New York, Silicon Valley, and London. He has worked in venture capital, public equities, private equity, and investment banking. He has seen firsthand the challenges in investing education, and is extremely passionate about building tools and communities that help retail investors sharpen their skills. So hearty welcome, Mr. Sharma. Glad to have you with us today.
Hi, thanks guys. Thank you for having me. Super excited to be here and to speak to you guys all today. Let me share my screen to get started.
While Mr. Shiv is starting on the share screen option, a quick note to the audience. Definitely you would have certain questions about the topic and the things that Shiv will be speaking about. So if you have any of those, do put it in the Q&A section, which you can find at the bottom of your screen or to the right hand side of your screen. You can put your questions there, and right after the presentation, we will have when most of the questions we'll try to answer as many questions as possible from the social media, from our social media sites as well. We've got quite a lot of questions from our Tether community. So we will be going through a Q&A section right after Mr. Shiv's presentation as well. So please put in your questions, whatever that you might have. So with that, let me pass on the virtual mic to Shiv. Over to you.
Sure, thank you guys. So just to start off here about me, who I am. I mean, as you guys mentioned, I've been an investor for a long time. I was at AWS for a short period, and then recently joined Stocktwits. I'm very passionate about investing education, and I clearly saw that, even the professionals get it wrong a lot, right? So if they get it wrong a lot, it is not that easy to do, right? And secondly, what I found is the first wave of fintech was giving access. Now, with Zerodha and Upstocks and Grow and Robinhood in the US, and there's a Robinhood of every country now that's live. But the next wave of fintech is actually how you make somebody a better investor. And that's a very difficult problem to solve. And there's really two ways I think you can solve that problem. One is by content, and YouTube is filled with content. There's no shortage of content on YouTube and are explaining this topic. And then also community, right? So in a community is where, you learn investing by doing and by failing and by doing and by trying and by kind of improving your skill set slowly over long periods of time. It's basically an apprenticeship model is the best way to learn investing. And that's why I joined Stocktwits, because to me, I think it's a huge opportunity for us to really help investing education at scale. Fun fact, we're probably one of the biggest investor communities in the world after Twitter and Reddit. Probably the largest pure play community for investing. And we invented the whole $ cash tag thing that you may see very often with Tesla or Apple or whatever it may be, right? And we've just now started in India. We're already kind of big on the social media side in India. So we have almost 4 lakh Instagram followers and quite a few Twitter followers as well. Not as big as the US yet on Twitter, but pretty big nonetheless, and growing very quickly. So I would encourage you guys all to give us a follow for pretty fun content. So what is Stocktwits, right? So Stocktwits is basically like a community, and it's a very deep finance community who only cares about investing, and we kind of mirror in data and tools, and also the chat concept, right? So you can go and follow any ticker you like Reliance or ITC or Tata Motors, whatever it may be, and see what everyone is saying and kind of get the pulse of the market. And we're really known for our trending feature. So the whole GameStop movement actually started on Stocktwits first before going to Reddit, and it's because we organize conversations by the ticker. So if you go to the whole GameStop page, you'll see like 24-hour conversations going on, and if that starts to trend, it shows up on the top screen of our app and then on our homepage, and then it goes viral because people see it and they say, "Oh, why is this stock trending?" And they go and just kind of creates a rabbit hole of conversations and community building and stuff. And so that's kind of how we were organized, and why we've done pretty well growing organically. And this is kind of our India launch. So we did the usual India stuff as part of our Series B. We raised 30 million in our Series B from FTX, a big crypto exchange, as well as Times Group's VC arm, who also brought Uber and Airbnb to India. And before I get into the whole meat of the presentation, I'll just have a few slides on our brand. One of the reasons why we're kind of well known in India now in the investing community is because of our memes. We really do well to connect with like the next generation of investors, and but the whole future of investing media, right, is not watching CNBC like your parents may do, right? It's kind of social media and kind of speaking the language that is very different to the youth and the Gen Z millennials as it is to the elders, right? And we have a very popular newsletter actually with a similar light, and it's written by somebody from Bloomberg Quint, who's 28-year-old. His name is Yash. He's amazing, and he kind of writes it in a way that's very easy to understand and very relatable, and there's very little jargon, and it's very fun to read. A very quick, fun read. It's a pretty popular newsletter even in India very soon. And on YouTube we have kind of the same type of content, but in video format that explains what's going on, and it's kind of for people of all skill levels, whether you're a very beginner or whether you're a pretty active trader yourself. We have content for all sorts of people. And so that's the Stocktwits stuff. Now I want to get into what you guys asked me to speak about, and so this is kind of my take now on the state of retail investing in India. And so first question is, just move this Zoom ribbon on the top, just I can't see the title. Okay, there we go. So the real question is here is, why does everyone care about the stock market? And like, why did you ask me to come speak here, right? And the reason is because very few places you can see these returns, right? And it kind of makes sense, right? You're like, people have always been interested in real estate and gold, but like, buying the best companies in the world and holding them for long periods of time, if Mukesh Ambani's portfolio can grow, and if you can follow him, pretty sure you will grow also, right? So if you just think about it very conceptually, like but it's very intuitive, right? So I mean, it's a bit like, you have volatility and it can be scary at times and all of those things, and you have market cycles, but generally over long periods of time, people have made a lot of money in the stock market. And so that's why kind of people care about it, right? And then one of the problems that comes out of that is that retail investors always chase the bull markets. So whenever markets go up, the media talks about it, your friends talk about it, demat accounts usually open and skyrocket, right? And this is something that Nitin Kamath, who I think is phenomenal and super smart, and he's very pro the retail investors, and he calls out, and so this is a chart that he posted recently on social media, and it shows exactly that, right? The media kind of caught onto the bull market and the whole retail investing trend, and demat accounts opened, and now we may see a pullback in markets, right? With all the noise happening around the world, it's inevitable. Markets don't go straight up, right? So like, it's not easy to invest. So then people are like, well, why should I invest if it's so hard and timing is hard and all these different things? And then these memes go crazy on the left. Like, this is a pretty viral meme that we had that people can relate to. And then on the right, like, this is a CNBC headline. You open up any TV channel, talk to your friends and family, open up social media, and you'll see red, 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 and especially this week. And so then the question is, well, why should I even do this? If I have to deal with this, can't time the market. When people tell me to buy, I shouldn't buy. What the hell do I do, right? So it's not easy to do. And then people say, okay, then they zoom out. They're like, all right, well, look back at the best companies over the last 10 years, right? I can buy mutual funds, what everyone kind of does, and you have many more mutual funds than you do demat accounts, right? And then you're like, okay, well, if I would have owned the most obvious best companies in the world, I'll significantly outperform the index, right? This is Facebook, Microsoft, Apple, Reliance, Google, TCS, Infosys, HDFC have all outperformed the Nifty over the last 10 years. Is that really a surprise to anyone on this video? Probably not, right? It's probably quite self-explanatory, right? And so that's kind of where we are. That's why people continuously try to do this on their own. And that's why people always want to pick stocks and be involved in the stock market. And then the question is, well, are you an investor or a trader, right? So this is a very popular question that you set up front in the title, is that they're very different, actually. An investor is somebody who is understands businesses in depth and looks at their financials and looks at their business and their business model and the competitive landscape and understands the companies in depth. Whereas somebody in technical analysis is more usually a trader, and they look at charts and things like that to figure out where stocks are likely to move in the short term. And the reality is you have to choose which one you are. It's not clear which one is right for other people. And so far, they both make sense for the right audience. And so, for example, like, one rule of thumb that I tell beginners that people usually abide by in the industry is fundamental analysis tells you what to buy, whereas technical analysis tells you when to buy. And so that's something I think is a rule of thumb that you can keep in mind. And that's something, if you're more longer term, if you're more of a trader, then of course, it still applies to an extent, but I think it's a bit different if you're a very active trader who wants to get in and out of stocks. And so I think that begs the question, right, is, what is the future of this industry, right? What will somebody's portfolio look like in the next 10 years? And on the left, you see a young professional, someone like everyone on this video, right? All of us are probably in that bucket on the left. And what do you want, right? You want to invest for the future. And ideally, you want to make some money, right? Who doesn't want to make extra money to improve their lifestyle and buy things they want and give gifts to their parents and all these things, right? It's very normal. A bit of greed is very normal. It's not bad. It's just the way the world works. Right? And so what that means is, I think, going forward, what you'll see people do is the following. You'll have a big chunk of your assets in mutual funds, which makes sense for most people. I mean, you may not get rich with mutual funds, but like, they do work and they give you exposure and they compound. And then on a DIY, do-it-yourself basis, you may have a few buckets of things that you like to do, right? One may be your LTBH, your long-term buy and hold, where you're buying these household names that you like and things like that. And then you may have a smaller bucket for speculative things like growth stocks and technology stocks and stuff that's maybe earlier in the growth curve that you don't want to be so aggressive with because of risk and all those things, right? That you feel very confident in. And then maybe you want to be a trader also to boost income in the short run, right? Maybe, in a bull market, you see opportunities to kind of learn from friends and follow other communities like on Stocktwits to see what other people are doing to make extra money, right? And of course, that usually happens the most in bull markets, less in bear markets. And so I think this is generally what a sample portfolio roughly people want and people will end up gravitating towards over time. And so now I'll just take a few questions from the crowd that I've been asked so far is, what is the investing tech landscape, right? And what that is basically on the left is the access to equities. And this is the list of brokers on the screen ordered by terms of size with Zerodha and Upstocks and Grow and the digital guys have now passed the legacy guys. And so clearly, I think you don't need to be a scientist to know that the digital native next generation applications and apps and websites that are targeting, that are not tied to financial institutions are doing a very good job. They're very nimble, they build good products, they have good marketing and all these things. They've raised a lot of venture money and that, right? And so they also have a very clean UI and UX that's not very complex and very easy to use and fun to use at times, right? And so that's been a enabler for many people to open up their own demat accounts and start investing on their own. And then another part of it is, well, all that is there. I have my Zerodha account, but what the heck do I buy, right? And that's where on the research side, there's quite a few tools, right? So TradingView is, our neighbors in the US who, are probably the biggest charting software in the world that, I believe they have 3-4 million Indian users and are quite big in India also. They're the most popular trading tool in the world and probably also in India. This is for the trader types, right? Then you have TickerTape, which is also, I think, owned by Small Case, and Zerodha is an investor in TickerTape. And that's where, a young investor may go to study the financials of a company, understand what the analysts are saying, what Dalal Street is saying, and what the financials look like, and kind of do their own research. Screener is very similar to that, except where you can screen companies by their financials. So maybe you want companies that have 30% growth, 20% profit margins, and a market cap below a certain amount in the IT sector. Well, then there you go, right? That's how you'll start getting these companies, and they'll facilitate your research process. So you can you can kind of reduce the number of companies you have to research, because otherwise your universe of stocks to invest in is in the thousands, I would imagine, if not more, right? Maybe lakhs, right? So that's kind of where we are. And then Trendline is a very similar to I guess, a TickerTape in many ways, and so is Stockage, right? So now you're seeing a lot of these research tools come up to help facilitate the analysis. And also what you're seeing is the social side, and that's kind of where we are. Is yes, you can research 50 companies, but okay, great. Which one should I buy? I can't buy all 50. I can't, or I can put all my money in. Or like, how do you go from 50 to 10 to 5 or 50 to whatever the right number is you want to buy, right? And that's where the whole social side comes in. Stocktwits is doing this in a specific to investing vertical, whereas the other social media platforms are all quite general and all do a very good job even now of aggregating people and helping people find other people that are like-minded. And it's also kind of driven to the concept of influencers and financial influencers, right? Where you see kind of like, this is a video we did with Akshat. Akshat is he's a fellow INSEAD grad of mine. He's 1 year before me, and he's become a very famous influencer now and works with many brands. And like here we did a video of kind of summarizing his portfolio, right? And there's many pros and cons to influencers, but they've done a phenomenal job of explaining these concepts in very simple terms, right? It's not easy to understand investing, right? In order to become an investor, you have to understand macroeconomics like RBI and inflation and all those things that that the media is always talking about. And you have to understand companies and what they do, and why certain companies are going to be doing better than others over long periods of time. And you have to understand sometimes the technicals to see, okay, well, we all know the IT sector is great, but like right now it's going through a very bad cycle. And anyone who looks at charts can tell you this a long time ago. You probably shouldn't be buying the dip just yet in IT stocks, right? So that's why, to put it all together, influencers have done a phenomenal job. And it's really like tough concept because we all have day jobs, right? Like we all don't spend 9 hours a day, 10 hours a day studying these things, right? So the simplest thing you can do, I just scrolling through Instagram in the evening, as we all do, right? Even our parents do that these days, right? So scrolling to Instagram, you can hear these concepts explained, right? It's a very powerful thing. So they get a lot of really bad like publicity sometimes, but I think if you use influencers for the right use cases, it's actually phenomenal. And it's really good. And so like you have many types of influencers across short-term trading, long-term investing. It's also in different languages. So some people prefer regional languages, or they speak in a way that's funny that they like, or whatever it may be. You now have a million different types of influencers for all the right topics you'd like to hear from in your own communities online. You can explain these concepts to you. But that's also a con, is that it's very hard to find. Like it's not so easy to, it takes trial and error to choose which one is a better fit for you and your exact style, because it's unlikely you're going to find somebody who does things exactly like you. There is no one in the world that has your situation financially or your knowledge in the same position. Nobody. So if that's the case, you have to kind of use some people for certain things and some people for certain things. And that only happens by trial and error. And as the algorithms get to know you better, they'll give you better recommendations. And maybe a few months to a year in, you'll have a nice portfolio of influencers who are popping up on your screens and your streams all day and who can be helpful to you. I think lastly, it's important to just, you should be using this for education purposes and not for investment advice. That's a very important point, because sometimes it's can be kind of easy. And even I sometimes will get kind of, will forget to use my brain a little bit. It happens, we all do it, right? So it's not wrong. You're not the only one. Don't blindly follow anyone. Even SEBI registered people, I think there you can have some trust, at least because of their skill sets and backgrounds and all of that. But I still don't think anyone should blindly follow anyone. I recommend everyone to at least learn a bit on their own and be able to make more credible decisions. But I do think for investing, influencers do give you good, they explain content in a way that if they'll summarize research for you. So you don't have to go and spend 20 hours reading stuff. They'll just kind of give it to you in a summary way that you can skim. And so it's good for the middle of the journey. So the first step of investors process is to figure out, okay, well, Elon is talking about Dogecoin. My friends are buying Reliance. The middle of the journey is the research piece. And that's where they're very valuable. Where they're not valuable is that final piece of which one should I buy, or how should I buy? How should my portfolio look like? So I think as long as you have that lens, I think the rise of the influencer trend is quite meaningful and here to stay. I also got a question in the chat about the rise of the retail investor and the economic value that's created, right? And I think long run, I think I showed you the indices and charts and of how well markets have done. I don't think they're going to be as straightforward going forward, despite, I think usually after bull runs, long bull runs like we've just had, things don't continue to go straight up forever, right? So I think anyone who has that expectation should really reconsider their goals and their priorities and their financial needs, right? Don't expect that from the stock market. But, just to give you a sense, like on the screen here, I've shown you CDSL and Angel One. Angel One is probably the biggest pure play retail brokerage listed in the stock market, and then you can see the returns have been phenomenal. Now, this is not exactly what the question asked regarding economic value created from stock markets, which is significant. There's no way for me to really quantify that, but this is another proxy to show how powerful this trend is and how early we are in India's adoption and awareness and knowledge of investing. And then, one more natural question I think anyone gets in every single time anyone speaks about the stock market is tech stocks, right, in India. And so, I just want to explain kind of what's going on here, right? And what's happened is that India's venture capital ecosystem is phenomenal. I think you guys are part of it in Bangalore, right? Like the level of activity and the funding and the market opportunities are ginormous. I think nobody is not aware of that anymore, right? That's a known thing, right? And so what's happened is that all these companies here, the Nikos and Paytms and Zomatos and Policy Bazaars have, raised a lot of venture money, and then they've gone public. And when you go public, you usually time your IPO at the time of peak valuations. And that's exactly what they did, right? So they timed themselves with peak valuations, right? And what happens in an IPO is that the reason they're going public is because all existing VC funds who've owned the stock, who've been investors, imagine the seed check guy or the Series A guy who's been in this for like 10, 15 years. He needs liquidity and his stake is huge, right? Paytm is not going to go sell itself at this point, right? So how do you get liquidity for the VCs and the founders is to go public. And what you see in IPOs is a gradual shift of a shareholder base from venture capitalists and founders and employees to public equity investors. A public equity investor could be a mutual fund sitting in Bombay, could be emerging market mutual funds sitting in Singapore, Hong Kong, London, New York, Sao Paulo, whatever it may be, right? And so that's what you're seeing. And so as you can imagine, when IPOs happen, there's always a lot of hype. Valuations are always very high, which is why they're going public. I mean, the question is, well, why didn't Paytm go public a few years ago? Or did not go public a few years ago? Well, why do you think, right? Because you usually time it at the right time. So I think what's happened is that you saw peak valuations. You're going to see existing shareholders sell their stake, which creates negative pressure. It also coincides in the US with the higher interest rates, which basically means that as rates go higher, you see less interest for various different reasons into further down the risk curve companies. So look at crypto. Crypto has gotten absolutely murdered. Why is that, right? As rates go up, people's risk appetite usually goes down, right? And these companies are not profitable today, and they were built in that kind of VC environment. I used to be in VCs. I know very clearly how quickly the shift has happened, how much it scared even everyone who's kind of been aware of this and who's in this ecosystem. And so what's happened is now people are saying, okay, well, we all know these companies are phenomenal, but what is the path of profitability? In fact, people will say they should already be profitable today. Why are they not profitable today? Are they not profitable today because the economics of the business model are bad, or because they're just investing in growth? Whatever it may be, let's get profitable ASAP. So, as we see some of these, I think, like Paytm, for example, has been very vocal since this regime changed, since this environment landscape changed. But their management has been extremely vocal in saying we'll be profitable by FY23, I believe, or whatever it may be, right? And so they've been communicating their story very differently than what they were doing in IPO time about profitability. And so, as I think, like, markets are always forward-looking, right? So if we know they're going to be profitable in a couple years, and they're already this far off the lows, and if you believe they remain market leaders, if the world doesn't fall apart, you could argue like they may be higher in the medium term, right? Don't know if they'll outperform the index or the large cap, but there's a chance like you're closer to the end of the bottom than you are the beginning of the bottoming process, right? And so also what's really good for these companies is their scale, right? These are all B2C companies, of which there's a lot of their competitors in private markets who now like do not have the capital access anymore to go compete with all these guys on the screen, right? So this market environment is really, while it's bad for their stock prices in the near term, it's really good for their competitive situations, right? Because I think we all know the cost of customer acquisition in India is very high, right? Given the competition everyone's advertising. Look at the IPL rates, right? Look how many startups are doing IPL advertising, right? That just goes to show you all the VC money. Everyone wants to acquire the next set of users, and the cost of doing that is going up. And guess who's positioned to handle that? Is probably these guys versus the competitors who are earlier on, who don't have the brand awareness yet, right? So that's my take on ecosystem and where we are today. This is not investment advice, but like I hope this gives you a lens of how I think about the world. I got one more question. That's a very long one, right? And that is, should I invest in small caps? What's the purpose of why small caps important, right? And the very clear answer to that is like, if you are a small cap company, you're usually smaller than the big companies. It's easier for small companies to double their revenue than for Reliance to double their revenue because their revenue base is higher, right? It's easy for 5 crores to become 10 crores and 100 crores become 200 crores because that's an extra 100 CR revenue you have to generate, right? So that's just the law of large numbers, right? And so if you look at the left side of the page, these are a few examples of companies who've gone through this process of going from small cap to large cap. And as you go through this process, you'll see the winners are ginormous. Compare these returns to the index returns in the previous slides of, of other large cap companies, and it's significantly greater, right? But you also have a lot of losers, right? And it's not that easy to pick small cap stocks, right? You need research, right? The management of these companies are some of the sharpest people in the world that are advised by Goldman Sachs and McKinsey and BCG on how to communicate their story and all those things, right? So like as an outsider looking in, reading their reports, hearing their interviews on YouTube, you're not going to have any insights. You're just not going to do it. Like unless you have the access of a hedge fund and you go to the factories and you do some checks, you talk to customers. Who has no retail investor the time to do all that, right? So it's really difficult. And even if you do, your timing could be wrong in terms of when these companies really do well, right? So like if you look at the index, the Nifty's returned 75% in the past 5 years, whereas the small cap SBI mutual fund is up 148%. That's good enough for most people, right? So I think that just goes to show you the disparity between upside in small caps versus the large caps in the Nifty, right? But I would say, like mutual funds do well. It is very difficult for most people to pick small cap future winners. I'll be very clear about that. But if you really must, if you're really interested and you really want to learn to do it, I can give you a framework. So I'm going to introduce you to this concept of CAN-SLIM. It's invented by a guy named William O'Neill, who's like a legend, even in India. Like any investor in India knows this book, right? This book is like one of the most read books of all time. The company that this guy, William O'Neill, has built is called MarketSmith. MarketSmith has a big India presence. It's called MarketSmith India. They have their own team in India. They're very active in India. And so there's a few things that he teaches in his framework, and it's called CAN-SLIM. So the C is basically the framework for how you can pick and find the next Bajaj Finance, the next future growth stock winners over time, right? And I would say it's not a trading style, but it mixes fundamentals and technicals, which is why I kind of like it. Right? I think it's a very clear way to explain what's going on, right? And I think, so I'll start through his framework, right? The first starts with the C. The C stands for current earnings growth, and you want to see accelerating earnings growth, right? The A is for annual earnings growth that's consistent over 3 years of over 25% and also shows strong margins. The N stands for a new product, new management, something new, like something that's not priced in the stock, something, just give me anything, a new product coming out, maybe in the case of Amazon, AWS, people didn't realize it was going to be this big, right? Whatever it may be, right? Maybe for Paytm, you could say some of the lending stuff or the insurance stuff or the brokerage stuff can become as big as the payments business, right? That mixed with supply, which is you want to see a very high demand, which means you want to see a lot of, but you want to see liquidity, which also means avoid the penny stocks for now. Like this doesn't really apply to penny stocks. This applies to like the best companies in the world. So the US examples of people that meet stocks that meet this requirement were the Googles and Apples and Facebooks of the world, right? L stands for leading industry group. So, every market cycle, you have different companies who lead. The last market cycle, since COVID, IT stocks have led. Go look at the chart of IT stocks right now, they're no longer leading, right? So if you were to apply Ken Slim, this methodology today, you would see IT would not show up on this list, right? And then I is, to me, my most important and favorite, it's institutional ownership. So what that means is, like, me and you don't move the stock market, right? Who moves the stock market is when the biggest money managers in the world with billions and billions, even trillions of dollars are buying a stock. A stock may be, for example, 1 or 2 billion in market cap, and these funds have trillion in market or 500 billion in market cap. For them to build a 1% position in that stock is almost more than the market cap of the stock, right? So it takes time for these guys to acquire the stake, and they do their diligence. And you want to own stocks where institutional ownership is increasing, not decreasing. If it's increasing, you'll see significant interest, and that's when you see stocks go crazy. It's usually the big money buying. So you want to look for clues of when is a big money buying certain stocks, right? And M is the market direction, right? So like if we're in a bear market and the general Nifty is going down, unlikely it makes sense for you to go and be very aggressive in the stock market, right? Like it's okay if you don't catch the absolute bottom. If you want to be a very active person in small caps and growth stocks, you want to capture the middle of the move because that's more than enough, right? You want to capture, you don't mind missing the bottom 20%, and you won't catch the top 20%, but you want to catch the 100 to 1000% of the middle of the chunk, right? And that's how you do your risk. And it's kind of a trading method, a trading style, but a longer term trading style, you could say. And I'll just give you an example of HDFC, right? So, everyone knows HDFC. This is in 2016, right? So you can see here, when this pops up on the screen is where this blue volume bar goes really high, right? And that's a very big clue because that means big money is buying this, right? And you can see starting this point is when the number of mutual funds owning it have accelerated, right? And that's what drives the stock higher and likely outperforms the Nifty in a big way. So that's what Market Smith and this whole William O'Neill methodology is all about, right? Is how you can find stocks that are in clear uptrends and owning them, and how you can, choose, how you can filter stocks to find ones that, that meet certain criteria. And it kind of makes it very mathematical. It takes the emotion out of it, which is very important, I think, in investing. How do you start, right? So, the thing is like, I don't know how to, it's all up to you, right? Like, what are your goals, right? Like, what do you want to do? Do you want to buy a car? Do you want extra money? Have you been laid off from a job and you want to learn to trade so you can have extra income while you look for a job? How much time can you spend, right? Once you have that down, you can build a portfolio allocation. I'd say something like what I showed in my previous slide is probably a good framework you can use of something where you let the pros handle mutual funds or ETFs, and then you have some that's on your own, whether it be the core names or some speculative stuff. But as long as you portfolio weight them and not put too much money in the wrong buckets that are overly aggressive and speculative, then you can't really go wrong, right? The key is just to be unemotional and be very long-term oriented, right? One more big tip I have is just to get freaking started. Just go and buy $500 of a Reliance and watch it go up and down. Because what's going to happen is you're going to watch the news a lot more if you have even a small amount invested in stock. It's going to matter to you. Like that means whenever some of your friends are discussing something or the other, or some Instagram reel comes on, or some headlines, WhatsApp forward comes to you, you're actually going to read it, right? And that's what you want to get started, right? And getting started is key because it's like tuition. I still do stupid stuff today, right? Like really, it just takes time. That's why some of the most respected people are always very old, right? Like the market teaches you a lot about life and psychology and ups and downs and cycles, and not getting too excited when things are going very well, and not getting too depressed when things are getting bad, and how you can take your emotion out of things and all of that, right? Also, just immerse yourself in things, right? Just force yourself to read. You have skin in the game now. You have some money invested in a few mutual funds or stocks, small amounts. Start reading Money Control, ET, Stocktwits is just our social media, our newsletter, our platform itself is quite, fun and easy to follow the stuff at, right? Watch CNBC. CNBC is, I agree, people criticize CNBC, but like they tell you very quickly what the pros are saying and thinking. Don't blindly follow them. The incentives are wrong. I understand that, but like what you learn from CNBC is the buzzwords, and you learn what money managers care about, right? Because when the money managers come on CNBC, they're actually pitching to you. They're there to say, give me your money for my mutual fund. That's basically what they're saying oftentimes. So it's actually not everything there is great, but a lot of it, the clips are quite good. They also teach you things, right? So for example, they'll explain to you things about like different industries. Sometimes, for example, if metal stocks are trending, they'll explain to you why the metal sector is hot. And you'll learn a lot, because like investing is hard, right? You have to learn about, if you want to do it like a pro, which not everyone should, right? But you're talking about the banking sector, the steel sector, the sugar sector, the paint sector, the IT sector, the pharmaceutical sector, right? Like, so the more you slowly accumulate knowledge over time, these small clips here and there, the smarter, more knowledgeable person you'll be, right? Our newsletter is really good for this, I'd say. And then find your favorite influencers on YouTube. Just try it out, watch. If you find it boring, don't watch it. So you'll find somebody who's not boring, right? And then like this is a like skill set thing, right? It'll take you years to build a skill set you absolutely need to get this right? So, find your style. Think about what it is you want to learn, right? Like if you're able to break down things like you want to be a long-term only investor, okay, buy mutual funds and just read books about like, that are more general in nature, right? Market psychology, maybe. If you want to become a trader and really find the next growth stock, then that book I shared before, How to Make Money in Stock, is a great start, right? Like there's people like the guy named Mark Minervini, he's a legend in India. He's an American trader, actually on Stocktwits too. And so he's like, people love him in India because he follows the methodology I explained before, and he's more of a medium-term trader type, right? And so, it takes and again, lastly, like it takes a lot to put a story together of a stock. If you take TCS for now, right? There's fundamental analysis, technical analysis, and macroeconomics, right? All three have to align for it to go well. In fundamental analysis, you have financials, you have business models, you have industry, you have FX issues, INR versus USD issues. Their clients are in Europe and the US. What's happening in those countries, right? So all these things you have to kind of build block by block by block knowledge about. So if you really want to learn this stuff well, and I'd say learning this stuff well, you may think, well, I'm never going to be an equity analyst. Why should I do this, right? And I would say, like, one, it's very intellectually interesting to learn these industries because these industries are ginormous. It generally improves your knowledge of the world if you were to start understanding how these industries are all tied together, right? And it'll help you be a more just smarter professional. Maybe your clients, sometimes you'll have clients in different sectors if you're in customer facing jobs, right? So I'd say it's generally only good for you, and it'll only make you have more money in the long run and just happier if you just do spend the time to learn these things and these topics, especially these industries over time. And that's it.
Well, thank you so much. And thank you, Mr. Sharma. And one more aspect of the millennial way is to ask questions, right? So celebrating this emotion, We are now opening the platform for questions from our audience.
Right.
Sure.
So, Vaishnavi, why don't you think we can take the first question from our social media itself? Do you think what we've got?
Yes, yes. So our first question from social media is about something that you just spoke about, is the difference between, so what is the difference between large cap, mid cap, and small cap investments? And what are the benefits of small cap investments? So I think you've touched upon it a little
Yeah, I would
bit.
just add quickly, the difference though is that a larger cap company is somebody who's later in their maturity level, right? So if you're very mature, it's a lot safer from a, like, I don't think TCS is going bankrupt anytime soon, right? Or is Reliance, right? But also the risk reward is better, which means your reward is slightly lower, right? So that's why some people are like, why should I even own these large caps? Just own all small caps and just only buy the small cap fund, because long run I'll do better. I mean, I can't argue mathematically that, right? That probably will happen, but it doesn't mean you should do it. But I mean, I understand why people think like that, right? So that's kind of the mid cap is right in the middle, as the name implies, right? So
Super. Thank you so much for that. And coming to another question, which is from our live audience here, they're asking which option is better? Is it future derivatives or options? So what is better in terms of investing in?
That's a super specific question. That's not a, I think I'd prefer to avoid that one. That's like very, it's one that's really up to you and based on the situation, right? So I don't have the right answer. I mean, for you, that depends on your exact trading style. I recommend you learn both. And that's if you want to be a super active, aggressive trader. I wouldn't recommend either of these options for alternatives for most people. So I think that's a separate conversation altogether.
Got it. So you're basically telling us to maybe test the waters, see what works for you, and then jump into specifics, right?
I mean, this level of specifics is he's basically saying he wants to be a trader. Is he going to do better in futures or in options? Because both are like F&O is futures options, right? So which one is going to be better?
Yeah.
That depends on the situation. So if you're looking at a chart and you know that I'm bullish on this for this time period, then maybe an option is better. Or maybe it's a derivative or a future contract is better, right? That's just too specific. There's no blanket one answer that answers that.
Completely makes sense. I'm pretty sure our audience will definitely understand that. We'll take another question, Vaishnavi.
So I think you've emphasized on the difference between trading and investing. So are millennials more inclined towards trading than investing? What are your views about the same?
This is something I think about all day. Okay, so I think in India versus the US, you see a lot more people who want to learn to trade than the US. In the US, you don't see as many traders. I don't know why, but I think you see a lot of traders in the US. Okay, now, sorry, a lot of traders in India, more than the US. But in the big overall scheme of things and the numbers, right? People still generally believe the share market is risky, and they generally still, many people are very bullish on the India story, right? India. So I still think more people are very interested in the long-term approach of just buying the blue chips, as I mentioned before, and holding them in the mutual funds and saying good enough, because India will grow and get much bigger over time, demographics and all those things. I think I see more of that, but relative to the US, a big chunk of that is very interested in trading. That is likely because you know, people want to make more money. Like, I think it's a very natural environment. I think like the stock market gives anyone the opportunity to not get rich quick, but like people do get rich quick in the stock market, right? Now, is it going to happen to you? Very low chance, but like, can you get rich medium quick in the stock market if you're really good over maybe 5-10 years? Probably, right? So I think people are gravitated towards the upside opportunity there. And people, yeah, I think that's a big reason why. I think, not everyone may, people are also like aspirational. People want to do better. They want to go on holidays and buy gifts for whatever, right? Improve the quality of life. So I think it's very normal. Trading is definitely part of the DNA in certain big communities in India, whereas in the US, it hasn't been so much in the DNA of the US, I think.
Right. Vishnu Rahul, who has joined here live, he has his question is a little bit of a follow-up question on the trading bit itself. So he's asking, how is online trading changing due to the millennial way of investing? So what would you answer to that?
Yeah, so the biggest thing that's happening is now the old model was you call your broker at Motilal or at Kotak or HDFC or IFL, and you say, what stock should I buy? Okay, buy them from me, I'll give you a small fee, right? Now, people are trying to do it themselves, right? And when you do it yourself, what it means is that on your phone, you can see your portfolio up and down second by second at all times, right? So that creates like, one, the fees are lower, right? Because you're doing it yourself. You're not paying some middleman to do it for you. But you're also spending a lot more time thinking about it because it's addicting. Like if you look at your portfolio, it'll go up 1%, down 1%, up 1%, up 20%, up 5%, right? So people are looking at the portfolios 24/7, they're glued to their screen. What that's led to is a lot of this, right? Like a lot of growth and like content, right? That people can relate to. And, I think investing is becoming more, if you think about sports and politics, right? You see similar memes and headlines, right? Like, I think investing will soon I think GameStop, COVID, Elon Musk, all Bitcoin has really accelerated the time it takes for investing to become a cultural phenomenon. And that's where we are today. And then lastly, I'd say, this whole influencer trend is here to stay. It may have gotten too aggressive too quick, but I think in 20 years, you're going to really, the next generation will definitely of investors will certainly I think influencers will get better. You're going to see professional investors, maybe in Dalal Street types, who realize that, they don't want to work for someone else anymore. They want to become an influencer and share their knowledge with other people, other like-minded people. I think you'll see more and more people do that. I think you'll see the quality of influencers significantly improve over time, because I think that means new business models, right? That means things like copy trading, maybe, right? Like we don't even know what it looks like, but I do know that the way millennials and Gen Z consume content is different than our parents, and that's going to be no different when it comes to investing.
Yeah, I think we're going to levitate on the similar topic about Gen Z and like millennials. So, how are young investors or millennials, reshaping the world by boosting the economic growth?
How are millennials reshaping the world by boosting? I don't even know what that means. Can you help me understand a bit of what that means?
Yes. So what do you think is the contribution of these young investors in reshaping the economic growth of countries across the world?
So I think, I don't know, but I'll tell you what I think. I mean, I think that, I think the next generation is more risk taking than our parents were, right? And what does that mean? I think people don't want to work at the biggest 100 companies in the world. I don't. No offense, guys, but I left Amazon to come here and do this, right? So that gives you, like, I'm not a Gen Z, but I think that tells you what people will want to do what they're passionate about, like me, for example. And they'll want to do stuff that makes an impact and get financially rewarded. They'll likely become pretty significant investors of their own. They likely won't keep much cash. Now, they probably should have kept cash before we go in a bear market, but put that aside. Generally, they'll be very interested in boosting their own salaries with income, not so they can go buy things, but so they can have better experiences and give a better life to their family and even retire sooner so they can do what they really want to do in the next phase of life, right? So I think the COVID has really pulled forward a lot of these trends. The rise of the influencer is one example of that, right? But I think it's even more than that, right? I think like Shopify and even Zoom, as we're on today, right? They've enabled, like, I know people who've left corporate jobs who are on the side, they love yoga and they go on Instagram and they teach yoga to their friends on Instagram, and all of a sudden they use the right hashtags and go viral. They have a global audience, right? And then they can do yoga sitting somewhere in India and do Zoom classes with people internationally and globally and charge in US dollars. And next thing you know, their cost is much lower, but like they have a very, high income, right, over time, right? So I think like you see a lot of more risk taking, a lot of more sort of different way you live life. Now, what's interesting is going to happen is, what I don't know about is that was true in a COVID world of low interest rates and all of that. Is that going to hold true in now in the next 5-10 years? I don't know. I really don't know, right? No one knows. If they do, you don't know, right? Like, for example, we all thought the work from home trend was permanent and no one can go to office ever and commercial real estate going to zero. Well, now people realize, well, productivity is not as high in work from home. And bosses are like, you know what? We just renewed this lease. We're cost cutting. Productivity is lower. Come to work, right? So you're seeing a lot of trends from COVID undo. My hunch is that it won't go back all the way as it was before, but generally people will stay kind of pretty entrepreneurial over time, and that'll only significantly increase.
Got it. Since we're speaking about the volatile markets here, so Jayendra has a question. Says, what is the best way to invest in volatile markets? So, I'll also add one extra bit there. So, first of all, what is the best way, and what are some of the small bits of advice that you would give for some of us who are maybe starting off investing in such markets? So, what would it be?
Depend on your style, right? So that framework I have here, like, people should just memorize, I think, this framework, right? Like, this is how my brain works, and so it depends. If your goal is you just want to basically hold things for long periods of time and you don't need the money tomorrow, this is for your future, then you can dollar cost average and buy slowly mutual funds, your long-term favorite stocks, right? If you think that the world is in a very, right now I can tell you, I won't give investment advice, I can tell you that Indian markets have held up very well, right? Look, if you look at the US markets, Canadian markets, they're not very similar. Now, that's a huge thing, by the way, and it's a good thing because India's economy is, very domestic, and India has its own growth story, all those things, and all that is fine. But generally, markets are correlated, right, to some extent, right? And after going straight up for a few years, this is not a time I would tell anyone to be very aggressive. Now, are there certain areas you can be aggressive? Perhaps, right? But I think the way you navigate these times is just by having a system. So knowing your goals and allocate accordingly, right? I would say mutual funds and long term. And then if you want to do an active trader, be very nimble and be very specific into what style you're following. Is it long or short? Is it calls or puts, right? So all of these things must be taken into account, right? And figure out who you're what is your, so yeah, I think that's how you navigate current markets. It just depends on you. If you have a follow-up question, I can answer a follow-up question, but that's the general answer to volatile markets. I don't know how low they will go. No one does. We had a Twitter Spaces last night with Samir Arora, and he's like, I don't know, guys. I have no idea. Don't ask me. I don't know. No one knows. If they do, they're lying to you, right? I don't know what Mr. Putin's going to do. I don't know what the U.S. Federal Reserve is going to do. So generally, I can tell you these companies, Reliance, HDFC, Infosys, TCS, Amazon, ITC, they've gotten bigger every year for many years. That likely won't stop tomorrow. The valuations will come down as the headlines get scary, but in 10 years, will it be bigger? Probably, right?
Makes sense. So in the interest of time, we'll actually be closing the Q&A section here. All the other questions that have come in and our social media questions, we'll try to answer them at a later point of time, maybe. So with that, Mr. Shiv Sharma, thank you so much for taking your time and to be part of today's webinar and addressing our Tether community here who have all joined. And yes, thank you so much. And the way that you explained with memes, with so much of relatable content, I think Vaishnavi, I can speak for Vaishnavi as well, where both of us were just nodding our heads and saying, hey, this is so relatable. So thank you so much for that. And thank you for being a part of today's webinar.
No, thanks for having me. Really enjoyed it, and hope you guys learned something. And if you want any get into questions, please follow me on Stocktwits or Twitter, and happy to continue the conversation.
Thank you so much.
Cool. Thank you so much.